Looking at more and more economists, analysts looking at 50 in May, 50 in June, a Federal Reserve that really needs to pick up the speed in which it's hiking. Do you see that, and what is the impact on your world of fixed income?
Yeah, Taylor, we do. We see and hear a Fed that is getting much more comfortable front loading rate increases and it really speeding up that process. So a 50 basis point increase in May and perhaps another one in June, we think is more likely. As we have to remember, they're tightening from other facets as well, right? The balance sheet will begin to roll off perhaps quite quickly starting at the next meeting. And we also have the largest fiscal contraction post World War II getting underway as well. So the tightening is real and it's definitely having an impact as we think about yield levels and the shape of the curve.
Gene, how much illiquidity is there in the market? How much are people experiencing that, certainly in the Treasury market?
Well, it's real, but I think liquidity generally is still pretty strong. The Treasury market, is still the deepest, most liquid market in the world, but we are seeing some signs of indigestion as you look at more off-the-run issues and those that might not be directly deliverable to a futures contract. But I don't think there's any evidence right now of anything we'd extrapolate into a broader financial contagion.
And Gene, I'm going to steal Taylor's line and go to credit spreads because you have seen them come in a little bit, both on the investment grade and the high yield side, but they're still much wider than they were at the start of the year. And I'd love to hear your take on the different crosswinds hitting the credit market right now and where that leaves spreads.
Yeah, I think that's an important point, Katie. We've had through the beginning of this year, really a crisis of correlations. And that's been due to a fear of liquidity being withdrawn globally. And what we see now, and if you look at the last few days of market behavior, what you see is yields rising and risk doing well, or yields falling when risk does poorly. Those are much more welcome correlations. And so I think this is because we've reached a level where credit spreads now have a much more reasonable risk premium. And I would argue an investment grade, probably too wide of a risk premium to account for what is still a pretty solid foundation of growth. And you can see that in the labor market and other data today. So I think where we are now is a much more balanced place where we can see going forward a much more favorable correlation between interest rates and credit spreads.
What is, though, a 10-year break even? I mean, at one point earlier this morning, topping 3%, it's no longer just 2s and 5s and those break evens that are moving higher, but sort of a de-anchoring of those longer term inflation expectations as well.
Taylor, I think that's probably the most important market event today is that we saw the 10-year inflation break-even rate hit 3% for the first time really ever in the history of the TIPS market. And this is what's pushing the Fed to really look at what may be, even in the back of their mind, seems like short-term commodity-driven inflation and make them fear that perhaps these moves can become embedded in expectations, which is when they start to lose credibility as a central bank. I think that motivates them to move more quickly and more aggressively. And that's what ultimately will drive a more aggressive inversion of the curve, which we think is coming quite quickly.
And that inversion in the curve signaling, as many feel it does, a recession or not, Gene?
It could, but I don't think that's what the conclusion we have to draw here at all. This is a very different cycle and the first one in over 30 years where the Fed is playing catch up to inflation. Typically, we've seen the Fed in the last several decades really preemptively raise rates to prevent the possibility of inflation. Here, inflation's the clear and present danger. It's if you look at the employment cost index, private sector service wages are growing over 8% year on year. So the inflation is there and they're responding to it. So I don't think that means it has to be a foreshadowing of a near-term economic recession.
And is it just an inversion or is it a sustained inversion? And given some of the technical factors, some analysts are saying you need an inversion this time around of 50 or 100 basis points to actually signal anything.
I think you do need a more significant inversion, but if you just take the Fed's own forecast at face value, they predict that over the next 2 years, short-term interest rates will be higher than the long run. So if you price that into the yield curve, you have an inverted curve, and I don't think there's anything wrong with that.
And Gene, before we go, if the Fed is front-loading hikes, what does that mean for real yields? Because if I look at the 10-year real yield right now, I still see negative 60 basis points. I mean, do you think that this hiking cycle will finally return those real rates to positive territory?
I think that'll be a sign of their progress, quite frankly, Katie. And what we need to see is a trade-off between real yields going higher and also inflation expectations going lower. And that's the combination that they need to regain credibility in the marketplace. And so that's the reason precisely why they need to move more quickly.